In this screencast, we are going to look at writing off individual accounts receivable. So in the last screencast, we looked at the valuation of accounts receivable and our estimates of bad debts expense and allowance for doubtful accounts. We did this under the percentage of sales method, where this was our bad debts expense, and then we came up with $6,300 for our bad debts expense under the percentage of receivables method. And right now that is what's sitting in these T accounts, is the percentage of receivables method, not the percentage of sales method. So that was all at December 31st, 2014. And now we have this scenario on February 2nd, 2015, Brown Dog Delivery Company determines that RT Tin's account is uncollectible. RT Tin has a balance of $500 in his account. What journal entry would Brown Dog Delivery Company record to write off RT Tin's account? Well, first of all, if we're into 2015, we have closed our income statement accounts, and so they would not have these numbers in there. They would have some sort of sales amount, hopefully by February 2nd, but we don't have numbers for that right now. And our accounts receivable, it would be a number, and we will say that we have not recorded any other allowance for doubtful accounts. We've not written anything off. So right now we're sitting with a credit balance of $5,000 in allowance for doubtful accounts. So when we write off an account, the account that we are going to debit is allowance for doubtful accounts. And we are going to credit accounts receivable RT Tin. So RT Tin has his specific accounts receivable. And if we've determined that his balance is uncollectible, we don't think we're going to get that accounts receivable. So it needs to go away. We need to delete that accounts receivable, which is why we're crediting it for $500. We are getting rid of that accounts receivable. We don't believe we're going to collect anything. And then, since we've credited something, we need to debit something, and we're going to debit allowance for doubtful accounts. And the reason we debit allowance for doubtful accounts is because in this allowance for doubtful accounts number is what we estimate will become uncollectible. When something does become uncollectible, we don't need it in the allowance for doubtful accounts anymore. We don't estimate that it's going to become uncollectible. We know that it's not collectible. So we would credit our accounts receivable for $500, and we would debit our allowance for doubtful accounts for $500. And we wouldn't do anything to bad debts expense. That's been closed. We're not going to adjust it anymore. We just work through the allowance for doubtful accounts. Then on March 12th, RT Tin does pay Brown Dog Delivery Company the full $500 he owes. What journal entries will Brown Dog Delivery record then? Well, in this case, Brown Dog Delivery is actually going to make two journal entries to record that payment. First, we are going to debit accounts receivable. And credit allowance for doubtful accounts. And we're going to do that for the $500 that was paid. And the reason we do that is, first, we have to put that $500 back in accounts receivable to give RT Tin an accounts receivable again with our company. And then we also credit allowance for doubtful accounts because we're putting that $500 back into our estimate. We thought that we didn't need to have that in there anymore, that it was uncollectible, but now it's become collectible, and so, well, we need to put it back in there. So now we are back to where we started. We are back to RT Tin has an accounts receivable with us. But he's paid. And when a customer pays, we get cash. And also, that customer does not owe us anything anymore. So the second part, the second journal entry here, is we need to record the cash that we received and get rid of that accounts receivable because our T10 no longer owes us anything. So this completes the 2 screencasts on valuing accounts receivable.